Hey everyone, Adam Bergman here, IRA Financial, and want to do an emergency YouTube live show on new tax legislation. This is some pretty big stuff. Didn't actually think all of this would get passed, so I just wanted to jump in, give everyone a quick summary of the new tax legislation. When I say passed, I mean actually just even get presented in a bill. So just today, the House Ways and Means Committee, they released the most detailed picture yet of the tax overhaul that the Democrats are designing to help pay for a major expansion in spending, as we know, on infrastructure, social programs, $1 trillion infrastructure bill, $3.5 trillion worth of revenue that they need to raise. So they are going to be busy in the next few days. And what has happened is the Ways and Means Committee has spent the last few months coming up with some ways in which they're going to raise revenues. And they used President Biden and his plan for really reconstructing the whole taxing system, including individual taxes, corporate taxes, capital gains regime, state tax, a potential elimination of the step-up in basis. So they looked at a few areas, including the retirement area, which I'm going to focus on. And it's a doozy. Okay, so let's start with some foundation. Okay, this, let me just preface, this is proposed. Nothing's passed. There will be negotiations. It's already slimmed down from what was expected. And we'll talk about that from a capital gains and corporate tax standpoint, as well as the elimination of step-up basis did not make it in. So there are some things that some would say are a little bit more moderate than some of the progressives want. On the retirement side, it's a bombshell, which I'll go through. And in fact, some progressives say it didn't go far enough. And Senator Wyden basically said, hey, I'm working on my own stuff. So this is pretty fluid. There'll be some changes, but just wanted to touch on some of the main sections in this proposed new tax legislation. Basically, any final piece of legislation will have to be agreed, obviously, by the House, the Senate Democrats. And they have, obviously, a very slim margin. They could pass this as part of the budget reconciliation. So they basically just need a majority in the Senate. They don't need 60 votes. And they do control the Senate with Vice President's vote, so they can do it. The issue is they need to make sure that some of the more moderate senators, like Manchin and some of the others, will go along with it. So let's get right into these proposed tax changes. I will give you my thoughts and opinions. This is not a political talk show, okay? I'm not a talking head that's Democrat or Republican. I've said I voted Democrat, I voted Republican. I don't really care about parties. My thoughts and opinions obviously are mine. They don't involve anyone at IRA Financial or anyone else. And I'm just going to give it to you straight how I feel, and we can take it from there. So the top individual rate, the proposal is to increase it to 39.6%. It's up from 37%, which is current. This is not a shocker. We all expected it. And you know what? We can all live with it. That's kind of what the tax rate was before Trump. If this was the worst thing they were doing that was going to be proposed and passed, we can all live with it. It happens. However, they're going to add an additional 3% surcharge tax on individuals with adjusted gross income of over $5 million. And we'll see this was actually proposed instead of the elimination of the step-up in basis. What the step-up in basis is, just if you're unsure of it, is basically when you die, your basis in your assets are stepped up to fair market value. So if you own Apple stock at $100,000 and you die and it's now worth $2 million, your heirs get the basis of $2 million in the stock. So all that built-in gain evaporates. So the issue is, what do you do with death, right? A carryover basis means there's no step-up in basis. Becomes very, very complicated to work from an accounting standpoint because sometimes people own assets for 20, 30, 40 years and go find what the basis is, right? They've changed financial institutions, changed accountants. It's a mess. So that's not workable. And then they also got a lot of pushback from some more moderate Democrats, especially in the Midwest, about family farms, even though there was supposed to be a carve out for family farms in the step up in basis arena. They still, some Democrat moderates said, we are not going to agree to any step up in basis elimination. It's a no-go. So that's what they've decided now is the Ways and Means Committee said, you know what? We can't get that through, so we're just going to do a 3% surcharge on anyone over $5 million. Good or bad? Yeah, I can live with this. I don't love increases in taxes, but 3% on someone making more than $5 million, their individual tax rate will then go up to 43% or so plus state tax. I guess we all can live with that. The next one is the capital gains, which actually came in a lot more moderate. The thought was that the highest capital gains tax rate would go to 40%. And what ended up happening is that the increased capital gain rate, the top rate of 20%, is now at least proposed to go to 25%. Okay, there will be a 3.8% net investment tax potentially on that as well. And plus obviously a 3% surcharge of over $5 million. So it basically is going to go up to about 28.8%, which is much better than 40%. Now this is the caveat if you're watching this and it's still September 13th, you actually need to sell stuff today if you want to get the old capital gains rate in. Although no one knows, do you have to close your deal? Do you sign your deal? We shall see. But this is basically going to be effective as of 9/13, which is, or 9/14, I should say. So you got maybe a few hours. The market's closed, but if it's a private investment, maybe you can sign the M&A documents today. Not sure how that's going to play out. But either way, again, the proposal was 40%. Now we're looking at about 28.8%. Much better. Still would rather have not the capital gains rate going up, but way better than 40%. They also want to expand the net investment income tax to basically capture more income. A lot of people played around with this with self-employment income. They want to expand that to capture more people. Carried interest. This was kind of a shock. I thought they were going to basically just flip it and treat it all as ordinary income, but they said no. They basically said that 3 to 5 years. So instead of just holding it for 3 years and getting capital gains treatment, you have to hold it now for 5 years. Okay, so this is a little bit worse than it is now, but not as bad as just flat out saying a carried interest is taxed as ordinary income. They're going to give you a higher capital gains tax rate of, let's say, 28.8%, but the investment needs to be held 5 years versus 3. Yeah, they'll retain the 3 year if you make less than $400K, but for big time private equity, hedge fund, venture capital folks that take advantage of the carried interest, they generally make more than the $400K, so you're going to have a holding period of 5 years. Obviously, there's questions if you have a fund with 3 and 5 year holding periods. What happens? It's just more accounting nightmare. Qualified small business stock. The exclusion rate will be limited to 50% for taxpayers with income over 500. So they've reduced the applicability of the qualified small business stock exemption. Not a huge thing, but something I wanted to mention. Estates, big stuff. The unified credit is now $11.7 million as of 12/31. This proposal aims to reduce that to $5 million per person. Okay, so that's huge. Right now, what that means is if you're married, you essentially have $23.4 million in estate tax exemptions, right? So if you're estate tax, if you're married, even though when you're married and you pass, your assets, even if they're $5 billion, go to your surviving spouse tax-free. It's only when your surviving spouse passes does your estate become subject to estate tax on a federal level, and you generally have the unified credit times 2, which is now $11.7 million times 2. The House Ways and Means Committee proposal aims to reduce that to $5 million per individual or $10 million per family. So more than half a reduction. That's a biggie, but they did at least as of now, aim to preserve the step up in basis. Senator Wyden's not happy about it. He wanted the step up in basis to be eliminated, but as of today, based off the Ways and Means Committee bill, the step up in basis is still good law, but they've reduced the unified credit down to $5 million. You know what? That at least makes sense than doing both, right? I would have had a way bigger issue if they eliminated the step up and they reduced the unified credit down to $5 million. So by just reducing it down to $5 million and keeping the step up, I guess it's a draw. Could be worse. By the way, you have another 3-4 months to start doing some serious estate planning, because this is supposed to kick in 2022, January 1, 2022. So if you have assets more than 10 million, if you're married, 5 million single, talk to a trust and estate lawyer tomorrow. Not today, tomorrow. You can do it. You can relax. There's a lot to digest. Have a couple drinks. This is big stuff. But tomorrow, call one, because you have a few months left. Also, from a valuation standpoint, it basically says that they want to ignore discounted valuations for non-business assets. Okay, some people took advantage of this and dumped in non-business assets in their estate and took a discounted valuation to reduce the asset value. Now they're saying, no, you can't do it. It only applies to businesses. Big one, corporate tax rate going from 21 to 26.5% as proposed. This is less than the 28% proposed by President Biden when he was in office and part of the, well, I should say before he got into office, and while he was in office and part of the Green Book's proposal. So not horrible. I would have rather it stayed at 21 or at least 25, but 26.5 is better than 35 or 28. So not a horrible thing. Again, they got rid of the step up in basis. I should say they kept it. They didn't remove the step up in basis, but they essentially replaced the elimination with a $5 million, a 3% surtax on or surcharge on anyone that makes over $5 million in income, which includes capital gains. So that's how they dealt with the surcharge. New York City residents, yikes. I used to be a New York City resident, still have an apartment there, not a resident of New York anymore. They can get doozy. You can get up to 60% in taxes, right? 39.7 plus a 3% or so surcharge if you have over 5 million plus state and city tax. You can be at around 60% tax. It's pretty bad. I love New York, best city in the world, but wow, that's going to hurt. So that's just the way it is. That was expected because we all knew that the high income tax bracket was going from 37 to 39. We also expected the 3%, or at least the Obamacare 3.8% tax to get on there as well. Plus this 3% surcharge is a new thing if you have more than 5 million in income. So plus state and local, you're looking at 60% plus. Retirement accounts, believe it or not, retirement accounts is and are a big part of this retirement legislation. I'm shocked. I've always said retirement accounts are bipartisan. I'm shocked that the Democrats are putting retirement accounts at, I should say, the forefront. Maybe not the main event, but it's okay. I would say it's not probably the main meal, but it's definitely like a really strong appetizer, maybe like a lobster appetizer. The main event, the main course are definitely individual income tax rates, corporate tax rate increases, the estate tax, unified credit reduction, plus corporate tax, individual capital gains. Those are the big main event / the meal. This is a delicious appetizer. I did not think that retirement accounts would make it so big, but unfortunately they did. We can really thank ProPublica and Peter Thiel, who was the topic of an article in June, who is reported moved or turned $2,000 in 1999 into $5 billion in 2019, and Senator Wyden and some of his friends didn't really like that. So somehow Thiel, and there's only 500 retirement account holders with over 25 million, 500. Roth and IRAs, 500. There's about 29,000 U.S. taxpayers that have IRAs over 5 million, pre-tax or Roth. Okay, so they basically are devising a lot of this legislation that I'm going to talk about now for about 29,000 people out of 330 million. There's $32 trillion of retirement accounts, almost 11 trillion of IRAs, and this group makes up a few hundred billion. Okay, so less than 2%. But somehow, you'll see, it's gotten the majority of the tax legislation. Number one, backdoor Roth IRA gone. The proposal is to eliminate the backdoor Roth IRA. If you make more than $400,000, you're gone. No more backdoor Roth IRAs. The mega backdoor Roth 401k, gone. They're essentially going to eliminate after-tax contributions in employer plans. Gone. So the ability to put away $58,000 or $64,500 in a solo K, which I've written extensively about, talked extensively about, could be gone if this proposal makes it through. Okay? They are not just punishing rich people, right? There's a lot of people that have and do mega backdoor Roths, don't have $5 million, don't have $10 million. They want to eliminate it. Okay? Same with the backdoor Roth, as I mentioned. They want to cap IRAs at $10 million. Not IRAs, 401ks and IRAs. Essentially, they want to cap, number one, your ability to contribute to a retirement account. So if you have an IRA or a defined contribution plan that exceeds $10 million in the aggregate, no more contributions for you. You're done. You're rich enough. According to the government, according to the Democrats, you're too rich. You don't need to save anymore. You're done. Goodbye. Okay? So they've arbitrarily at least made a decision that it's $10 million, I guess $20 million per family, per couple, but that's their number. It was $5 million, so at least they did raise it, but in their eyes, if you have $10 million in an IRA or 401k in the combination, in the aggregate, $20 million per household, you're done. Goodbye. You can't make any more contributions. And again, this limit would apply if you make more than $400,000. Okay? So if you make more than $400,000 and you have $10 million in total retirement accounts, you're done. No more contributions. Mega IRAs. Guess what? If your combined traditional IRA, Roth IRA, your 401k plan exceed $10 million, you have to withdraw 50% of the excess the next year. Okay, and it's $20 million. If your account totals $20 million or more, you have to pull from the Roth first. So basically, they're saying, again, this is not just Roth. This is pre-tax as well. So they're saying this: if you have more than $10 million pre-tax or Roth, the next year you have to take 50% out and potentially pay tax. Okay, you can take out the traditional. Now, what happens if you're under 59.5? Do you have to pay a 10% penalty as well? Who knows? That will flesh out. But right now, the little we know based off the Ways and Means Committee proposal, you have more than $10 million in an IRA or 401k combined. The next year, you got to take out 50%. If you have more than $20 million, the first 50% has to be Roth, or the first at least tranche has to be Roth. These are essentially new required minimum distributions, not based on age, guess what? But best guess based on value. I'm choking on my words because I can't believe in the United States that we are actually capping people's wealth. Hard to believe, right? You know, what's next? Slippery slope. Are we going to start telling small businesses, hey, if you make more than X amount, you need to just give it a rest to charity? What's next? I mean, this is crazy stuff. Yes, I am certainly opinionated. I can live with increasing individual tax rates. I can live with increasing capital gains tax rate. I can live with increasing the corporate tax rate a bit. But to just cap people's retirement account, I have a policy problem with that. Okay, for me, I don't care if the number is 10 million or 50 million or 100 million or 2 million. It is bad precedent, and I don't think the government should get involved in our life and tell us from a retirement standpoint how much is too much. So they're penalizing us for saving, and they're penalizing us for making good investments. And we'll see the type of investments that they want to penalize and basically prohibit you from doing. So just overall, I'm against this cap. I think it's just like I'm against boycotts, I'm against caps. I don't think it's good policy to cap people's wealth. Some people will say, hey, Adam, what do you care? It's 10 million, 20 million per household. Like, that's a crazy amount of money. What the hell do you care? You're right. It's a lot of money. I don't care. But why are we penalizing people from saving and doing smart investments, right? The person that bought Bitcoin 10 years ago, the person that invested in Tesla 10 years ago or 8 years ago, right? The person that invested in a startup, the person that did everything they were told to do is now being penalized potentially. So yeah, the 10 million threshold is better than 5 million. It's still, I have a problem with capping someone's retirement wealth. Just don't think it's fair and reasonable. I don't know of any, I did some research. don't know of any other country, developed country in the world, that caps people's retirement. Okay, it basically says, well, you have this much, you're done, you can't contribute more, and you got to give it back. And I'll explain, actually, I might as well just jump in it now. It's actually going to hurt, I believe, tax revenues. I'm not sure how much this is going to raise. All these things I'm going to talk about are not huge revenue raisers, right? There's 500 people with more than 25 million, okay? There's 29,000 with more than 5 million. So let's say there's 15,000 with more than 10 million. So we are designing tax policy for 15,000 people out of 330 million. How much revenue are you going to raise? Probably not a lot. Number two, you think these people are stupid? What are they going to do? Okay, all the money they're making you take out, they're going to pump it into life insurance policies. They're going to pump it into irrevocable trust, and they're going to shield it from the estate tax. Okay, guess what? IRAs, 401ks are all part of the estate tax. So that unified credit they just reduced from 11.7 to 5, that's great. The estate tax is taxed at 40%. That's big money. That's more than capital gains. That's more than ordinary income. So what they're going to do is they're going to take money out of the IRAs, which are subject to estate tax, and they're going to allow people to buy life insurance policies or dump it into irrevocable trust and shield it from estate tax. Crazy, okay? They're going to realize this. If this does get passed, and again, I'm not sure it gets passed. I spoke to a few people, made some calls before this YouTube live event. The people I spoke to, and they were 3 tax attorneys, 1 estate planning lawyer, and then a lobbyist, and they all said, I'd be shocked some of this stuff gets passed. It's so outrageous. And what they did say, and again, they're not Republicans, they said, this is the stuff that's going to force the Democrats or cause the Democrats to lose the House. Because it's just un-American. People, I don't think enough people care if people are saving in the retirement account. And I think there'll be a backlash personally against some of these Democrats who are just overstepping, I think, their responsibilities and their duties. I think this goes above and beyond capping people's wealth, even in a retirement account. In fact, if you look down the road from a tax collection standpoint, it's going to actually hurt tax collection. But politicians don't care what happens in 20 or 30 years. They just care about one thing. What is it today? Paying for the infrastructure bill and making sure they have the money for the $3.5 trillion budget. That's all they care about. So they're just basically finding ways to get there. I mentioned the backdoor Roth IRA is finito. If this proposal passes, that's gone. The mega backdoor 401k, finito if it passes. Accredited investors. Okay, this thing is ludicrous, out of control. Yes, I'm in the self-directed IRA business industry. This is bad. Okay, it's not bad just for us. It's bad for America. So what this next proposal wants to do, it wants to prohibit, not allow, prohibit IRA investors from making any investment that requires the IRA owner to have accredited investor credentials. Basically, it stops you from doing crowdfunding, private placements, Reg A's, Reg D's, crowdfunding, potentially hedge funds, private equity, venture capital, real estate funds, any investment that requires someone to be accredited, the IRA holder in this case. They want to prohibit the IRA from doing it. Crazy, right? They want to pull money out of mainstream America. IRAs, there's $12 trillion almost in IRAs, $32 trillion in retirement money. A lot of that, a significant amount, goes into funding small businesses, whether it's through private placements, whether it's through private initiatives. A lot of money goes through the retirement world to fund startups. Guess what? That's going to end. They want to dry that up. I have no idea what the heck they're trying to do here. It makes no sense. Zero. Clearly they think there's abuse going on. And I'm going to keep going back to Peter Thiel. Guess what? If this law was in place in 1999, Peter Thiel would still have been able to invest in PayPal or Facebook. He didn't need to be an accredited investor, likely as a executive into PayPal. Okay, Facebook likely either. So it's crazy. I'm shocked. I don't think this will get passed or into law. I think the Democrats, hopefully, the moderates, will wake up and be like, what the heck is this? We can never agree to this. This is going to take money out of small businesses that need the money. Retirement accounts are a huge source of wealth. Many Americans are cash poor and retirement rich. And guess what? Not all want to invest in mutual funds or ETFs. Some actually want to invest in startups, private businesses, private placements, crowdfunding investments. They want to stop it. At least the Ways and Means Committee proposal wants to stop it. This is a mind-blowing proposal. I'm going to have like a half a bottle of whiskey tonight to just digest this thing. I can't believe it. Again, sitting in 2021, United States of America, that they want to stop retirement accounts from making private placement investments that are regulated by the SEC. They want to stop it. Guess what? It only gets worse. There's more. Okay, number one, they want to increase the statute of limitations for IRAs from 3 to 6 years. Don't ask me why. They obviously, think there's a lot of abuse out there. I can tell you, I've been in this business 12 years. There's less than 3% of all IRAs. So there's $11 trillion, 58 million IRAs. There's less than 3% in alternatives. How much abuse are they going to find? There's not. There's a small percentage, much less than what's going on in the small business corporate world. I don't know what the heck they think is going on. Peter Thiel did nothing abusive. Okay, they tried to audit him. A 6-year statute wouldn't have helped. A 20-year statute wouldn't help. He didn't do anything wrong. Okay. We are regulated trust companies. We're not letting people just take their IRA and buy Rolex watches and Mercedes and Porsches. It's not happening. Okay, and I hope if someone on the Ways and Means Committee, someone on the committees are listening or watching this, trust me, it's not happening. The abuse is not there. I can tell you, it's not there. Okay, so fine, you want the statute to be 6 years? Whatever, no one cares. You're not going to find any abuse. Just make it 12 years. No one really cares. That's not the issue. The accredited investor issue is major. This is another biggie. So they want to stop your IRA from investing in any entity where the owner has substantial interest. So guess what? They want to now change 4975, and instead of having a 50% threshold, they want to reduce that to 10%. So that means if you are an owner of a business and you earn more than 10%, even if you're passive, your IRA can invest. Again, they're trying to stop Peter Thiel. Guess what? This would not have stopped Peter Thiel. He did not own 10% of PayPal. He did not own 10% of Facebook. He did not own 10% of Palantir. This is, again, another mind-boggling proposal. How much abuse do you think's out there? Anyways, IRS, you have the tools. Under 4975 C1DE, you could always use self-dealing conflict of interest to attack transactions under 50%. You've done it in the Rollins case. You've been victorious. But to just have a flat 10% threshold is wrong. How many people are passive investors into businesses? They own 15% into a company, let's say, has 300 shareholders, 800 shareholders, 75 shareholders. And now let's say they want to invest a little bit more in their IRA, maybe another 0.5%. You're going to prohibit it? Crazy stuff. Changing 4975. Again, this is all in response to Peter Thiel. Unfortunately, the committee, Ways and Means, the congressmen are not aware that this would not stop Peter Thiel. This would not have stopped any of that stuff. Okay? Accredited investor, maybe it would have stopped Facebook. It wouldn't have stopped PayPal or Palantir likely because he had some involvement. He didn't own more than 10%, but he had some personal involvement as an executive in those businesses. The last thing is they want to treat IRA owners as disqualified persons. Guess what? The industry has always believed that. If you read the tax code under 4975E, an IRA holder is a fiduciary is clearly a disqualified person. So no problem. That's just common sense. Everyone's agreed to that. We're fine with that. Big issues here. Okay, the IRS, they're going to get, as part of this bill, $80 billion more money, $80 billion to use as enforcement. Okay, trust me, you can use all of it for IRAs. You're going to hardly find anything. You're going to lose your money if you want to spend money enforcing IRAs and retirement accounts. People are not abusing retirement accounts. People are trying to make good investments. Okay, first of all, 99% of retirement account holders don't have the opportunity to invest in like these private placements / private businesses that they're involved in. They're not into that. Okay, they don't want to get in trouble. They're scared of the IRS. They just want to diversify and do well in their retirement account. So even if you take all $80 billion and audit every IRA out there or every 401k, you're going to find pretty much nothing. Okay, so I hope a lot of this doesn't get proposed. Senator Wyden still wants more. He's out for more blood. The House is going to pass the final bill in the coming weeks, and then it's going to be up to one of the Democrat senators to stand up and say, I'm not into this. This is wrong. You're going to need to change this. Hopefully that will happen. If Senator Manchin's listening or some other more moderate Democrat, listen up. The cap is wrong. Do not support a cap on retirement accounts. Europe doesn't do it. Canada doesn't do it. America should not do it. It is not in line with our goals and our, I think, initiatives to be free, right? We are always told, hey, if you save and invest well, it's the American dream. We all can make it. Well, the IRS said, can't make it that much. We're going to cap how much you can make. Yeah, I know I'm going to get pushed back. People are going to say, Adam, you're stupid. $20 million is more than anyone ever needs to live. Agreed. I'm not talking about the money. It's principle. You should not be capping if someone does well, right? I have a client. I did a podcast. He turned $400,000 into $34 million. That money came from insurance policy he got when his son passed away in active duty. We're going to force him to say no. That money that you were going to use for your son's foundation, sorry, you only can use $10 million of it. Is that right? I don't know. Just doesn't seem right. And I'm worried, what's the next shoe to drop? Is it private businesses, you can't make more than $30 million in profit? Apple, you can't make more than $1 trillion in profit? I mean, when does this stop? Yes, we have antitrust rules that stops anti-competitiveness. This has nothing to do with anti-competitiveness. Wealth building in a retirement account is not zero sum. I can have money and so can my neighbors and so could all of you. There is not a zero sum game here. There is no anti-competitiveness. Okay? It's craziness. So I hope if a Democrat is listening, please push back on this. If you want to eliminate the backdoor Roth IRA, okay, whatever. Eliminate that. Not a big deal. It was eliminated prior to 2010. So if you want to get rid of that, I don't agree with it, but fine, go for it. You want to get rid of the mega backdoor on a solo K? I disagree with it. It's people are saving, putting in money into a Roth. It's not hurting Treasury. There's no tax deductions. So I hope there's a pushback against the mega backdoor. I don't see it as a tax raiser. People may just do Roths, or they may not put it in, or they may put money in insurance policies. So I'm not sure of the revenue raisers in that provision. Accredited investor prohibition for IRAs. This needs to be removed. This needs to be thrown in the garbage. This is rubbish. This is ridiculous. And I am pissed off. Okay, I can't believe that this actually made it. I heard rumbling about this a few weeks ago. I said, no, there's no way sensible Democrats, smart tax policy committee members would ever agree to this. It just makes no sense. There's too much money at stake. There's too much money that could help mainstream America, small business, raise money, and they continuously look to retirement accounts. I cannot believe that this made it in. This needs to be pushed out immediately. Same with the statute. Why should this be 6 years versus 3? But okay, if I have to give in, I'll give in on this. Again, 12 years, 15-year statute, you're not going to find much abuse. There's always some abuse, but trust me, it's way smaller than the abuse that went on with PPP, the abuse that goes on between S-corps and W-2s, the abuse that goes on with home office deductions and house and meals and entertainment deductions, way smaller. This is nothing. Then the other big thing, the 10% threshold instead of 50% for investing in a business where the IRA owner has some personal involvement. I think it's a weak rule. Again, I use the example, you own 11-12% personally. It's a company with 200 shareholders. You want to put another 50K in your IRA, you can't do it. Again, the 4975 will stop it, right? You have 4975, C1D, and F. It will stop it under self-dealing and conflict of interest. The IRS has the tools. They can fight the cases they want. They don't need to go from 50 to 10. And again, just reinforcing my point. This would not have stopped any of the Peter Thiel stuff. Nothing. Okay. So that's kind of it. I mean, I'm just really upset. Really upset. I knew the cap was coming. I've talked about it. I actually thought it would be 20 million per person. I didn't think it would be 5. I'm shocked about the accredited investor prohibition, the 10% prohibition, the mega backdoor 401k. I didn't see that coming. I knew the backdoor Roth was in jeopardy. It's a bad day for all Americans. If this gets passed, which I hope it doesn't, I'm praying to God it doesn't. It's a bad day for Americans because it's a slippery slope. What's next? What are we capping next? Right? Is it wealth? Are we going to cap life insurance? Hey, no one should have more than $2 million in life insurance. We're going to cap how many cars someone can drive, how big someone's house is. What's next? How many homes can someone own? Right? How big is a home? No one should own a home more than $25 million. Okay? No one should have more than $10 million in an IRA. No one should have more than a $5 million life insurance policy. What's next? Right? My kid's baseball card collection, it's too much money. No one should have collectibles worth $2 million. You know, it's bad policy. Whether the cap, I'd still be pissed off if it was a $100 million cap. It's just policy. Yeah, I know, 20 million is a lot of money. It's not the money. It's the fact that this is policy. That this can set precedent to say, hey, we did it for an IRA. Let's do it for life insurance. Let's do it for the next initiative. We need to raise money. Who cares? We got this through. Let's get it through again. If any of this stuff gets through, I'm warning Democrats, it's going to hurt them in the next election. I don't believe Americans, rich, middle class, even the poor, really care if people save in a retirement account. It has no foundation. It's not a big revenue raiser. It's not a zero-sum game, right? It's not like you're taking money out of income earners that make more than $5 million, right? 3% surcharge, you make more than $5 million. Hard for me to sit here and bitch about, complain about, right? The guy makes $5 million, pay 3% more, get over it. Okay. But someone who saved in a retirement account for the last 30 years, did really good investments, and now has that 10 or 11 million bucks in IRAs and 401ks, right? Not just IRAs. In 401ks or IRAs in the aggregate, we're basically saying, tough luck, take all the money out that's in excess, 50% a year. And again, is this targeting? 500 people have more than 25 million. Okay, so the threshold's 10 million. 30,000 or so, even less, about 29,000 have more than 5 million. Right? So if 15,000 or so have more than 10 million, we are wasting our time on policy that's not even going to raise much money because there's no estimation on what people are going to do with that money. They can dump it into life insurance. They can invest it into irrevocable trusts. No one knows what they're going to do with it, right? It can sit in cash. There's no guarantee that it goes back and is invested in capital assets. So not going to raise a lot of money. It's basically attacking 15,000 Americans, rich Americans, right? That's the four-letter word, rich. And that's too bad, unfortunately. Again, I'm pretty reasonable. I can live with minimal income tax increases individually. Yes, we went through COVID. We have to deal with $4 or $5 trillion in spending. There's some stuff in the infrastructure bill that could help all of us, right? Our infrastructure is a mess. Our roads suck. Our airports are disgusting compared to the rest of the world. There's some good policies for childcare. Listen, I'm family paid. Free community college. I'm into some of the stuff. Like, okay, I can live with some of this. It's going to help all of us. I can live with it. Okay. You want to increase the corporate tax a little bit? Okay, I'm down with it. You want to increase the capital gains tax a little bit? Okay. Individual tax a little bit. Play around with the estate tax. Okay. But to just basically rip apart retirement accounts and basically incentivize people not to save and do other things and force people into equities and different investments that you feel is safer for them is wrong, and it's overreach on the part of the government. And I really hope that Democrats stand up and say, listen, we're okay with some of these initiatives. We need to raise some money. There's some great policy initiatives the president's thinking about, but hey, we're putting our foot down. This is pushing it. Senator Wyden, Congressman Neal, we appreciate your service, but we disagree. This is way too far. Now, again, Wyden did this in 16 when President Obama was president, but the difference is the Dems didn't control the House, Senate, and presidency. That's the difference. There was there was a check and balance. Now there's no check and balance. The Democrats, as I mentioned, just need to get a majority, and they'll get it in Congress. And it's up to Senator Manchin, some of the other more moderate senators, to basically say, no, sirree, this doesn't work. We need to get back to the drawing board, play around with some of this stuff, and hopefully X out a number of these proposals that I talked about. So this is big, okay? This is huge stuff. This is bigger than the Trump tax plan, way bigger, because it didn't mess with people's retirement. It lowered, obviously the Trump tax plan lowered taxes, but it didn't impact retirement accounts. This is big, right? There's almost 60 million IRAs out there, right? $32 trillion in retirement accounts. 11 trillion IRAs. This is impacting lots of Americans. Yes, and it'll impact you even if you don't have $10 million. Why? Because if you wanted to invest in a small business or a private placement or a private equity fund, hedge fund, venture capital fund that required you to be an accredited investor, you can't do it. If you wanted to invest in a business that you own more than 10% of, even as a passive investor, this bill won't let you do it. That is a problem. So I'm just ranting, I know. Let's see what happens. I don't want to make this political, so I'm just going to stop here. But if anyone is watching or listening, Democrat, Republican, hopefully you're sensible and understand the value of strong bipartisan system. The retirement system works, and it works because there's support from both sides. And pushing this through when the Democrats have complete control will impact future cooperation. I believe in the Ways and Means, the Senate Finance Committee. Eventually the Republicans will get control of either the House, Senate, and probably the presidency at some point. Things will backfire, and it's just, again, bad policy, and I don't think it's a very good initiative, and it's not going to raise a lot of money. So again, I'm hopeful that a lot of these provisions won't make it in, but want to share it with you. Don't want to scare any of you out there who are self-directed investors, who believe in diversification, believe in making private investments into crowdfunding and other accredited investor platforms. I hope it doesn't change anything, but more to come. We'll know a lot more in the next few weeks. I promise to do another Ask Adam or YouTube live show as soon as I have more information, but just want to get it out there. If you're watching, subscribe. You could always check us out at IRA Financial if you have questions or information about self-directed investments, IRAs, 401ks. We're happy to help. I'd love to hear from all of you. And that's it. Now, someone else should be topping out the mega backdoor Roth. Yeah, I mean, I believe this will probably go into effect next year. Again, they're retroactively capital gains as of today, so this probably will go into effect next year. So yeah, this could be the last year to do the mega backdoor Roth as well. We'll learn more. Again, they may not make it in. It's just now, this is just the Ways and Means Committee. Senate Finance will have their say, and then committees will have their say, and then they're going to have to share it with their Democratic constituents. Well, I want to say constituents, but no, they're Democratic colleagues, and then there will likely be pushback from some Democrats saying this is too much. Our constituents just aren't going to go with this, and we are going to push back. The big thing again, funding for small businesses, private placements, retirement accounts play a huge role, and I'm not sure the Ways and Means Committee and some of the underlying committee members understand what they are trying to accomplish. Yes, they're trying to stop the next Peter Thiel, but bottom line is wouldn't have stopped him anyways, especially not in PayPal, likely not in Facebook, or maybe in Facebook as a private placement, but probably not in Palantir either. So we shall see where it goes. But anyways, we appreciate you guys listening and watching. This was just short notice. I like doing this. I'm going to jump in and do more of these. And hopefully you guys enjoy it, and much appreciated. Have a great evening, and thanks for watching. Take care.